How you guys doing tonight? My name's Adam. I'm an attorney, and I love working with law trades. One of my favorite things is helping my clients figure out the best way to structure their business, and structure their affairs in order to protect themselves, and also achieve all their business objectives. That's the goal at the end of the day. So the first thing I'm going to talk about is some of the sort of corporate essentials. What is incorporation, and why do we do it? So incorporation can take a lot of different forms. Basically, you choose a business entity. It could be a C Corp, an S Corp, an LLC, and we're going to go into more detail about those different kinds of entities. But really, there's one common thread among all of them. When you form an entity, you're going to get limited liability. And that's the number one reason to do it. When you have limited liability, it means that if someone sues your company, they're suing your company, they're not suing you. If your company goes bankrupt, it goes bankrupt and not you. That limits your own personal exposure and sort of provides a really important level of protection. Another really important factor when you're choosing what kind of entity is how you're going to be splitting the equity. So obviously, if it's just you running a business, there's no question about that. But if you're going to have co-founders, if you're going to have employees or consultants or other people that you want to share a piece of that pie with, you need to have a structure that's conducive to that. And a business entity is the best way to do that. Obviously, incentives and a capital raise for investors, that's another reason you might want to be able to split up equity. There's an enormous amount of credibility that can come just with having an organization. You just come up and you're like Joe off the street, but you have ink in front of that. People tend to give it a little bit more respect. When you sign a contract, something like that, it seems a little bit more real. It can also be a vehicle for holding assets. You see that a lot in real estate transactions or intellectual property. The reason for that is, again, that you keep those assets isolated from the other assets. So like if you have a holding company that owns a building, if that building goes bankrupt, it's just a holding company that's sort of under duress, and your other assets, your other companies, your other buildings can stay free and clear. So once you've decided that you're going to form an entity, you really have to decide, well, what's the entity I'm going to do? And there's really four standard options. There's the partnership, the C corporation, the limited liability company, and the S corp. And in addition to choosing what entity you're going to use, you also want to choose what jurisdiction you're going to incorporate in. Incorporation is a creature of state law, so any state will allow you to make one, and a lot of people think, well, I live in New York, so maybe I should make a New York one. I think that's usually wrong. I almost always advise my clients to incorporate in Delaware, and one reason for that, and this is maybe my first little piece of free legal advice for the night, is that in New York there's a law that says that if you have a corporation and you have an employment lawsuit about wages, and your corporation is sued by an employee, the owners of the corporation can actually be personally liable for that. So in order to avoid that, we usually say, let's go incorporate in Delaware. But that said, you do have to make sure to apply for doing business in any state where you're going to do that. So it's a pretty simple form. You just file with the New York Secretary of State or any other state where you're going to actually be doing business. So I'm guessing if anyone's been to one of these before, you've seen a chart like this. Limited liability applies pretty much across the board. The one difference is if you have a partnership, the general partner doesn't have limited liability. So if you just have a regular partnership, each partner is fully liable all the time. And if you have a limited partnership, there's still one partner who's fully liable, but the limited partners will have limited liability. Taxation is a really important factor that people tend to care about a lot because it means more or less money in your pocket. There's two kinds of taxation generally. The first is corporate taxation, where any profit by the corporation is going to be taxed at whatever the corporate rate is, both at the state and at the federal level. And the other is pass-through taxation. And pass-through taxation means that any profit by the corporation is treated as if it's directly earned by the people who own the corporation. So it sort of shows up on their tax return instead of the company's tax return. A C Corp is your standard double taxation entity, and the S Corp, LLC, and partnership are all pass-through entities. As far as management, a partnership is managed by its partners. A C Corp has a really rigid structure for management that's determined mostly by state law, and you can get around some aspects of that, but for the most part, on a plain vanilla corporation, it's all going to be determined by the laws of the state that's in. An LLC you can do virtually anything with. Really, you can have very exotic structures, but that can also be really difficult because if you want to have just a really basic structure, you also have to put in a lot of work to just make something that just works. Whereas with a C corp, it's sort of already out of the box works. And an S corp works just like a C corp. The only difference really is the taxation. This is an important factor. Investors, right? What do investors want to see? Just to cover some of the main points, investors don't like partnerships. They don't want to have the pass through because that affects their taxes. They don't want to have unlimited liability. That's just way too risky. It's not a really good choice for that. C corp is like the standard choice if you want to go for venture capital financing. Venture capitalists love C corps. It's just very predictable. They know what's going to happen. It's easy to set up, and having the different kinds of common, preferred, and hybrid instruments is really easy to set up with that. And also you can have an IPO with a C corp, which you can't do with the other entities. And an LLC is very flexible. Most investors won't want that. The pass-through of taxes is the primary concern. And also certain kinds of investors, like venture capital operating companies, will need to be very careful that they maintain the control issues that are the requirement of the VCOC, or they can have negative impacts for investors like pensions.